Good morning, everyone. It's Monday morning, December 19th, 2022. This is Rob McDougall here with the Zhang Financial Weekly Economic Update. So we'll go through last week's economic data as we always do, talk about how the markets responded to all that data, and then take a look at the data coming up for this week. So for last week, plenty of economic data, but the only one that really mattered was the FOMC, Federal Open Market Rate Committee decision, which occurred on Wednesday. But prior to that, we did have some inflation numbers, were actually good. So on Tuesday, the CPI index came in at 7.1% increase year over year, much better than the month before, which was 7.7%, and better than expectations, which was 7.3%. So that was positive. Core CPI, that's CPI ex food and energy, also came in better than expected, positive 6.0 year over year versus 6.1% increase expected. Then Wednesday, as the markets were rallying based on the inflation news, things were looking good. The FOMC announced their rate decision, which was a 50 basis point increase to the Fed funds rate. That was expected, no surprise there. But the surprise or the disappointment was during the press conference afterwards with Jerome Powell. It was very hawkish, much more so than we've seen him this year. So the markets reacted very negatively to that, particularly U.S. equity markets. So what was discussed during that press conference? A few things. The terminal rate, or the ending Fed funds rate during this tightening cycle, the expectation was in September that would level off at 4.6%. Right now it's 4.25 to 4.5 is the range. So in September, the terminal rate was discussed as 4.6%. That was moved up to 5.1%. Separately, U.S. GDP growth expectations taken down considerably. I'm not sure there was a number given before, but the expectation now for 2023 U.S. GDP growth barely positive, 0.5% per the Federal Reserve based on their expectations with the rate tightening cycle that we're in. Also, the Federal Reserve announced that they would continue to run off about $95 billion of securities, both treasuries and mortgage-backed securities, off the Fed's balance sheet, so not a big surprise there. Some of the other stuff that was discussed, though, was the Fed's resolve to get inflation down to 2.0. Now, Fed uses the PCE, the Personal Consumption Expenditure Index, which we'll see in a few moments because the November reading will be released later this week. That's a metric that they use. It's over 6% at this point. The Fed wants to get down under 2%, which is where we were for over a decade post the housing crisis. So Jerome Powell really underscored the desire to get inflation all the way down to 2.0%. Talked about that terminal rate increase. And so in total, the market reaction was very negative, particularly stock. And initially, the bond market came back later in the week. Currency markets also off, largely, I think, because of that terminal rate expectation of the 5.1%. Inflation expectations, though, last week came down. So we saw the CPI number better than expected. So expectations for inflation by investors has actually gone down. This is a great chart. If you take a look back to May, the expectation was we were going to average over 3% inflation over the next 10 years. Last week, that metric came down to 2.13%. That's about the lowest we've seen in years. So it went from 2.26 the week before down to 2.13%. So that's a very positive element. Also last week, the Atlanta Federal Reserve, who produces a monthly update to their expectations for the quarterly GDP growth, for fourth quarter, it had been 3.2%. They brought that down a little bit to 2.8%. My guess is going to be, given what the Federal Reserve announced and the data points that we have coming up this week for economic news, I'm going to guess that number's going to be coming down next week. Thursday last week, retail sales, that was negative. Now, this is good for inflation, but not great for the economy. The expectation had been retail sales for the month of November would drop by 0.1%, so barely down. Actually came in at a negative 0.6%. So Again, good for inflation, not great for economic growth. Also, that retail sales number ex auto, that was expected to come in at a negative 0.2, and it came in pretty much in line. So the market response last week, negative certainly on the equity side. I think this is all based on the Federal Reserve's discussion. So equity markets down, the bond market rally in the second half of the week. The bond market did rally in the second half of the week. So for the week, the S&P 500 down 2.05%. There was not much difference between value and growth, slight advantage to value. Not much difference between small cap and large cap returns. Small cap was a little bit better. And on the international side, pretty much in line with U.S. equities. The MSCI All World Index ex-U.S. was down 2.24%. So the bond market did rally. The 2-year yield dropped 1.16%. The 10-year dropped 11 basis points. So the U.S. aggregate bond index was up last week 80 basis points. So this week, the economic calendar is very busy. There will be 4 housing indicators that come out this week. We're not going to go through the charts on them because they're all the same. Housing definitely slowing in the U.S. So we're going to have housing starts, building permits, existing home sales, and new home sales. All 4 are expected to be down from the prior month. So what do we have this week other than the housing? We do have on Friday the Personal Consumption Expenditure Index. Again, this is the Federal Reserve's preferred measure of inflation. I have it here in chart form on a month-over-month basis. The expectation is it will rise 0.2% for the month of November. Month of October was a positive 0.3%. Also, we'll have the November PCE core. The consensus is that's actually going to rise 0.3%. Last month, it was up 0.2%. So in total, between those two, I would say inflation just slightly expected to be slightly better for the month of November for the PCE. So the last economic data point for this week on Friday is the personal spending number. Again, this feeds into both the inflation and the expected GDP growth. The consensus is personal spending for the month of November to be up just slightly, 0.1%, but that is down significantly from 0.8% in October. So that's it for the economic data and returns for this week. Thank you very much for watching. We hope to see you next week. Thank you.